fund?
Well, basically what we're talking about is an indexed annuity that has a floor to it. It's not going to go below a certain return, probably 5% or 6% or something like that. And it's probably indexed. Typically, it'll be off of something like the S&P 500. The problem is not the index, or indexing. The problem is not the floor. The problem is that the annuity fees are double what you get with a mutual fund, and his commissions are 4x what he would get if he sold you the same mutual fund, same index, without it being in an annuity. And so this guy wants a commission. You need to run.
I can't believe you just said that. Come on, Dave. Now, with all due respect, when it comes to other investments, you might be the expert. When it comes to fixed index annuities, your explanation was wrong.
Everyone in our office were just as shocked as we were. So we thought, why not do a reaction video to help clarify how fixed index annuities work?
And don't worry, we will expose all the fees and all the commission regarding annuities and compare them to investment fees as well. Hi, I'm Kai.
And I'm Ann. And here is Gracie, our retirement puppy.
And she's going to be judging you, Dave.
That's
now, now let's first rewind what Dave Ramsey says about fixed index annuities having a floor. Take a look.
Well, basically what we're talking about is an indexed annuity that has a floor to it. It's not going to go below a certain return, probably 5% or 6% or something like that. And it's probably indexed. Typically, it'll be off of something like the S&P 500.
Well, Ann, what would you like to say to that?
Okay, let's discuss a couple of points that Dave mentioned that are correct. The first part is that fixed index annuities have a floor. That's true. That's what makes it fixed. You'll never lose your principal.
Now, don't get this confused with variable annuity, friends. Those are subject to market risks. And if you want to add a floor, there is a cost to that.
Exactly. There's no fee for the fixed index annuities floor. Another reason it's called fixed is because of the underlying floor or minimum guaranteed interest rate. However, what was incorrect in Dave's statement is that the floor is where the annuity will not go below a certain return, probably 5% to 6%. This is not only confusing, but very misleading.
Now, to Dave's credit, he did say the word probably. But what makes it confusing is the floor with many fixed index annuities is 0%. Just Google it. You'll see many insurance companies, the floor is 0%, not 5 to 6%. And with a low interest rate environment we've had in the past 10 years, if any carrier offered a minimum interest rate, the rate has been around 1% or less.
A better way to understand the fixed part of this annuity is your base savings or brokerage cash account. Your principal has a natural floor where there's no underlying risk.
Ann's right, but honestly, I wish the word floor was never used. It honestly doesn't make any sense. Think about it. Would you ask your stockbroker, what's the floor in my cash account? And what kind of look would your banker give you if you said, what's my floor in my savings account? You know what he would say? What the?
Right. The word floor has confused many new advisors as well.
Even seasoned advisors have used the word floor and said it would not go below a certain return. Now, what makes that misleading is the word return. The client would be expecting a return when in fact many companies' floor is 0% with no guaranteed minimum return.
So it's better to say your money is sitting in a cash account and you may not have a minimum interest rate at all.
Right, no one should say probably 5 to 6% because that can be very misleading.
Right, so to clarify, as promised, the fixed index annuity floor is anywhere from 0% and up. But don't get this confused with the regular fixed annuities that are not tied to the index. For those fixed annuities, you will get a fixed interest rate, much like a bank CD fixed rate.
Right. So how do you make money? How do you make interest then in a fixed index annuity? And why is it called a fixed index annuity? Well, this is where the second word in this annuity comes to play. The first word we just learned is fixed. The second word is indexed. Now, Dave Ramsey said that these annuities follow the index, which is correct. But if you watch his entire video, he doesn't clarify how it follows the index or how you make money. So we're going to clarify this for you. And please let us know in the comments below if this explanation makes any sense to you.
First, fixed index annuities have no downside risk because it's not an investment.
What do we mean? Well, think of your bank's checking and savings account. Would you call that an investment account? Of course not. According to FINRA, the Financial Industry Regulatory Authority, here's how they define investments. A key difference between an investment account and a bank account is that the value of assets in an investment account can fluctuate and can, in fact, decline.
So how exactly then is a fixed index annuity categorized? Here's a hint. They're only sold through an insurance company, never through Wall Street. Even if your financial institution or advisor sells them, it's always through an insurance company.
Got the answer? Yes. The number one mistake that people make in understanding fixed index annuities is that they do not know that it's an insurance policy, not an investment. To let this sink in, let me give you a quick example. Let's say you give a friend a $100,000 loan. Your friend promises your money is safe anytime you ask for it back. In the meantime, he's doing his own investment. However, he says to you, hey, look, instead of paying you a flat 3% fixed rate, I'll pay you based on the performance of, say, a basketball team. The Warriors. Go Warriors. Now, neither you or your friend bought the Warriors, right? You're just simply following or tracking the Warriors' performance from one season to another season. Now, suppose they had a bad season. What's the worst that would happen to your principal? Nothing. Your friend would owe you zero interest, and your friend would not lose any money either. Well, did he take your money and purchase the Warriors? No, he did his own investments, right? Now, if the Warriors do well, then he rewards you based on their performance. Likewise, the insurance company will protect your principal if the index goes down, yet rewards you if the index performs well. Did that make sense? If not, call us and we'll explain this further. Upside potential, no downside risk. Now, come on, that sounds too good to be true, right? It would be if your money is actually in the market.
Remember though, your money is sitting in the cash account.
Exactly. You're not buying or selling any shares of the index. If your money was actually in the index, then who would absorb the risk? The insurance company? No way. How can any company afford that?
So if you're not taking any losses and the insurance company doesn't absorb the downside risk, how do you receive the credit from the index?
Well, let's first understand how the insurance company makes money. If you look at most insurance companies' investment portfolios, you'll see something similar to this. 74% bonds, 13% mortgage loans, 4% short-term investments, 1% real estate, 8% other investments. Now, did you notice the bulk of the investments for the insurance companies where? Yes, 74% is invested in bonds.
Yes, insurance companies cannot risk taking the majority of your money and dumping it into the stocks or the index. Why are insurance companies so conservative? Well, unlike the banks whose goal is to loan out your money, insurance companies must have a low-risk assets in order to provide liquidity to pay claims.
So here's a key point. The insurance company is investing your money, but in their own investments. The majority in bonds, not the index. So their investment or investments have no direct influence on your account's balance.
And the flip side is also true. Any loss of the index that you are following does not have a direct impact on the insurance company's overall portfolio. So, to recap, you're not buying the index, and the insurance companies have their own investments. Your money is safe, sitting in a cash account, similar to your bank savings account. Now, let's test your knowledge. Suppose the index you're tracking is going down. While this is happening, does the insurance company care?
Here's a hint. The insurance company is doing their own investment.
Right. The answer is no. They don't care if the index goes down because they have their own investments.
That's right. And you don't care since you're not invested in the market. It's sitting in a cash account. Therefore, your principal is protected.
Now, see if you can answer this question. Regarding the index you are following, does the insurance company care if the index is going up?
Oh, that's interesting. Here's a hint. Suppose the index you're tracking goes up 15%. Sounds good to you, right? But what if the insurance company is making only 10% on their bonds? Not so good for them, right?
So how do the insurance companies prevent this from happening? They limit your earning by having a cap or a low participation rate. What do cap rates and participation rates mean? We'll show you in a video to watch in a bit to learn more.
Now, that's why there are many fixed index annuities that we personally would never sell, we would buy for ourselves because of their low caps and low participation rates. Now, here at KCIIS Retirement Advisors, we will show you the companies that do not limit your earnings that have no cap and have high participation rates. And we'll show you another video in a bit to watch on how to avoid these annuity scams as well.
Right. So to sum it up, if the index goes up from one point to another point, the insurance company will give you a credit into your cash account. And where would they get the money to pay you?
From their own investments. And if the index is down from one point to the next point, then you'll get 0% credit. That's why we like to say, 0 is your hero.
This is the main reason why these became so popular since the 1990s. Who wouldn't want to receive the upside potential while getting rid of the downside risk in retirement?
Yes, 1990s, folks. This is nothing new.
Now, you might be wondering, fixed index annuities don't sound too bad. Well, in fact, they sound pretty good. So how can someone as established as Dave Ramsey not get this right? Well, financial advisors do not specialize in annuities, even though many advisors can sell them.
And there are many financial advisors, believe it or not, that even sell real estate. But who would you rather ask to get the best advice on real estate? A financial advisor like Dave Ramsey or a real estate specialist?
And who are fixed index annuities sold through? An insurance company, never through Wall Street. And while many financial advisors can sell them, you'll see the clear difference between our specialty and transparency.
It's interesting that you mentioned transparency. Not only were Dave Ramsey's final comments not transparent, they were a flat-out lie. Let's take a look.
The problem is not the index, or indexing. The problem is not the floor. The problem is that the annuity fees are double what you get with a mutual fund, and his commissions are 4x what he would get if he sold you the same mutual fund, same index, without it being in an annuity. And so this guy wants a commission. You need to run.
Dave, come on, man. You teach the public many great things, but what you just said is a flat-out lie. To quote you, you said, the problem is that annuity fees are double what you get with a mutual fund. You're not even stretching the truth. That statement is a flat-out lie. Listen, everyone. Every fixed index annuity, the good ones and the bad ones, are built with zero, nada, no fees. Some have a higher cap and higher participation rate. It might give you the option to have a small fee or spread, but there will always be options with no fees. And if you add a lifetime income rider, there might be a fee around 1%, but that's an option if you want it or not.
Yeah, you're right, Kai. Going on 19 years now, all our fixed index annuities have 0% to no more than 1% or so in fees.
Exactly, Ann. And Dave, you made matters worse when you said, and his commissions are 4x what he would get if he sold you the same mutual fund, same index. Dave, why? Now, I understand you have your own opinion, but why stretch the truth? Let's be honest with everybody. Most financial advisors charge around 1% to 1.5% to manage your investments, right? Now, we're not including fee-based advisors. The one-time commission for annuities is around 2% to 6%, much like real estate. Did I say one time? So how did he stretch the truth then? Because he did not say it was a one-time only commission. So let's do the math and draw this out. If a financial advisor charges 1% per year and has a client for 20, 30, 40 years or so, how much in fees did the financial advisor make?
That's 20% to 40%.
Exactly. According to my math, that means the financial advisor would make around 5x to 10x selling a mutual fund or index fund compared to selling a fixed index annuity. And that's not just 40 years. We're not including the heirs that continue working with that advisor or the advisor's broker-dealer.
Friends, that's a lot. Friends, no one, not even your financial advisor, can charge you management fees or on fixed accounts, such as your Social Security, pension, hybrid pensions, fixed annuities, or fixed index annuities.
The only annuity that any advisor can charge is a variable annuity, which, as you all know by now, we're not fans of anyway.
There will never be a consultation fee if you call us. We represent over 50 plans in 50 states and will shout the best rates for you, all with no cap and high participation rates.
And as promised, click here to learn more about caps and participation rates and how you can easily be scammed.
And did you know there are 5 different annuities? Well, to learn more, watch this video here.